So, famous economist comes out and says George Gammon is wrong. Which one is it?
We have got some drama in today's episode. I am responding to a full-scale assault that was launched by my good buddy George Gammon. So George, who's host of the Rebel Capitalist podcast, great guy, very good economist, analyst of the financial sector. And he recently released a video where he was pushing back against my recent article at the Infineo website. So let me just preface all this by saying this isn't merely a squabble among econ bros, but this actually is quite relevant to you as an investor. All right. So specifically, I'm not going to here in this video give you financial advice in the sense of, oh, this is what's going to happen in second quarter of 2025. And so you want to have your portfolio positioned accordingly. It's not going to be that sort of analysis. But what I am going to do is show you a coherent, systematic way to think through the implications of falling global demand for US dollar assets, right? So that's what the topic is. So the bit of a context to then go into George's video. And of course, as you can guess, I disagree with his conclusion. And I'm going to, in this video shortly, give you some excerpts and show you precisely where George went awry. It's a neat little exercise. And by the way, I think it was an honest mistake that I understand why George thought he had put the nail in the coffin to my worldview. And I'm going to show where I think, it's step 4 in his argument. He went off the rails. But before we get into that, let me just give you the big picture. So I and some others have been warning about falling foreign demand for US dollar denominated assets. And I was back in February of 2024. I was on a zero hedge debate. Jim Rickards was my partner, and we were arguing that there was going to be a more rapid fall in foreign holdings of USD assets than the conventional wisdom would have thought. And on the other side, one of the guys was Brent Johnson of Dollar Milkshake fame. And one of the particular arguments that Brent deployed to say he thought there was a mechanism in place that was going to make it harder for the dollar to lose its global status was he said, look, there is a lot of outstanding foreign held US dollar denominated debt that's issued by foreign institutions. Okay. And he said, so this foreign debt poses like an inbuilt reverse Uno card such that if foreigners try to unload their USD assets, because in a sense they were loaned into existence and there's corresponding liabilities held by foreigners on the opposite side of that trade, that the very act of them trying to de-dollarize would involve deleveraging as the loans that created those dollars effectively are canceled out. And thus the quantity of dollars, broadly speaking, on planet Earth in the financial sector of the globe would shrink. And as we know, shrinking quantity of dollars goes hand in hand with a rising dollar price in the foreign exchange market. All right. And so Brent was saying that it's not enough for you, Murphy, and you, Jim Rickards, to argue that, oh yeah, on the margin, foreigners around the world, as they look at, what the Federal Reserve's been doing with its reckless policies and the U.S. authorities and their treatment of, Russian tied assets and so forth, and just a lot of portfolio managers around the world might be thinking on the margin, you know what, I want to reduce my holdings of USD assets because over the next 20 years, I don't think that's a currency I want to have so much exposure to. He was saying, even if they tried to do that, given the realities of our current system and how leveraged it is and so forth, and the fact that it's debt-based, that no, there's going to be this process that kicks in that will sort of reverse what they're trying to do, at least in the short to medium run. All right. And so on Twitter, I was really trying to pin down Brent's position. And I said, okay, so you're saying if the global demand to hold US dollars falls, that can strengthen the dollar. And he said, yes. And then I flipped it and said, does it work in the opposite direction too? That if foreigners around let's say investors in China for some reason have a change of heart and they want to gain more exposure to US dollar assets. Are you saying that could make the dollar fall in the currency markets? And Brent said yes. Okay. So here at Infineo, I wrote up a lengthy article walking through why I thought that was wrong. And now George is doing a video response to that article trying to say why I'm wrong. So I think at this point, let me give you some excerpts from George's video that'll be a bit snappier, and then I'll just provide the vehicle by which I can respond and make my points. Let me also mention, of course, in the notes for this particular video that you're watching right now, I'll have a link both to my original Infineo article that caused this controversy, but also I'm writing a follow-up that's going to summarize what I'm saying right now to you in this video, and some further thoughts that I wanted to do in terms of clarifying my position that I laid out in the first installment. So all those links, of course, will be in the description here on this video. Okay, so let's turn to George's video, and let me just give you a flavor of how he starts out.
But let's get into Bob's argument here. So and by the way, this makes sense, right? Well, if there's less demand for dollars, then obviously the value of the dollar is going to go down. Maybe not so obvious. Okay, the title of today's installment may seem obvious. This is Bob talking now. After all, foreigners want to reduce their holdings of USD. Wouldn't that clearly result in the weakening of the dollar against their respective currencies? And you know what's great about today's video is you're unless you're a long-time viewer, you're going to learn a lot about the monetary system. And you're going to possibly learn things that you've never even heard of or never even considered. So I like doing videos like this. They're really good. And therefore, I'm really glad when Bob calls me out and gives me an opportunity to talk about this stuff. So he had a debate with Brent, and he says, as Brent spelled out in our zero hedge debate back in February, the extensive Eurodollar system complicates things. It's not necessarily the Eurodollar system that complicates things. It's the way the dollars are created. It's the monetary system. It's that dollars are lent into existence. When a bank gives you a loan, they're not loaning you dollars. They're not saying, hey, we need some dollars, so bring them over here. We're going to lend them to this guy. No, they create brand new dollars that didn't exist before. So when those loans are paid back, the amount of dollars goes back to zero. So it's not really an issue of the Eurodollar system. It's just the difference between the view that dollars exist, kind of like gold coins. Well, these gold coins exist. They're here. They're right here. So if no one wants these gold coins anymore, then the value of these gold coins relative to other things is going to go down. That's the main, that's 99.9999% of even experts see it this way. But in reality, that's not the way it works. We don't have any gold coins to begin with. They're none. So what happens is these gold coins are created by lending them into existence, right? So you have to understand that it starts with a loan. It doesn't start with the money being printed and existing. They're looking at dollars like green pieces of paper.
Okay, so you see, George, we're both friends, just in case people aren't getting that. So some of this is just us being cocky guys posing for the cameras and doing WWF drama. But after praising me and saying, "Oh wow, I'm a very respected economist," where there was a lot of sighing at this portion of the video, where George just can't understand how I'm missing something so basic. And let me just say at this point, for those who know both George and me on this, what's the likely explanation here? That I don't understand what Brent and George are talking about when they say in our modern economy, the way things work, loans are creating dollars out of thin air, and it's the bank granting a loan that causes the dollars to come into existence. I have written literally books on this kind of stuff, right? My most recent publication with the Mises Institute is Understanding Money Mechanics. right? So lots of chapters devoted to both the general theory and then the real world complications, after the financial crisis and so on, of this process by which banks, in a sense, create money out of thin air when they grant loans to people. Okay, so as George is sighing here, and geez, Bob's just, I guess he's asleep at the wheel on this one. The explanation is not that I don't understand the subtleties involved and that there's something special with dollar denominated assets that are created through lending operations. I get that. All right. So I think what's happening here is George is not fully understanding the point I was trying to get across in my original article. Okay. So having said that, now let's continue. Let's play another excerpt from George's video.
Bob here, he says they keep focusing on a reduced demand to hold a particular type of claim on USD with a reduced willingness to hold any dollar denominated asset. We have right here, we have derailed. All of a sudden we were doing so well here. Then we derail. That's not really what Brent's talking about here. Okay, well, let's get back to the global demand. So here is Bob's argument. Let's first analyze the situation with the assumption that any institution holding gold. So now Bob says, okay, an easier way to, well, I'll just read you what he says. In order to solidify my perspective, I think it will be most useful in the rest of this post to focus on something tangible. This is where we completely derail. And this is the problem right here. For that reason, we now proceed to analyze the global demand to hold bars of gold. You see what I was saying at the beginning of the video? This is the big problem we have. It's that we're looking at dollars as though they're just these green pieces of paper. There's something physical. They're tangible.
Okay, so here, George again is understandably confused. Like, why is Murphy focusing on gold when the issue is we're talking about intangible dollar assets that are created de novo through bookkeeping operations? Okay, and so I explained in the article why I chose this route. Okay, there's in this context, there's two different things going on that can cause confusion. So on the one hand, the underlying reserve asset, the base, if you will, are actual legal tender official US dollars. Okay. And in our modern legal environment, and given the existence of the Fed, there are two things that qualify. Number one is actual green pieces of paper with pictures of dead presidents on them. Okay. Or I guess Benjamin Franklin was never a president. Okay. Right? You got $20 Andrew Jacksons, $100 Ben Franklins, and so on. Green pieces of paper, a Federal Reserve note, that's legal tender US currency. That's held, I think there's something like $950 billion of that held abroad, often, by clandestine figures who are engaging in unsavory activities, and they need to be passing suitcases full $100 bills to each other. So there's that element, but also reserve balances held with the Federal Reserve itself. Okay, so in the United States, a commercial bank, it has reserve balances with the Fed. Those are electronic. It's not that the Fed is holding a vault full of paper currency, and that's what Citibank's reserve balances with the Fed. No, it's all electronic. Okay, so there's that element. Those are the underlying reserves. Now, the banking system pyramids on top of those reserves dollar liabilities, right? That if you have $1,000 checking account balance with Bank of America, legally speaking, Bank of America owes you $1,000. And given just the way our economy works, merchants in general are happy to accept claims on Bank of America as if they are interchangeable with green pieces of paper. but both economically and legally, they are distinct things. Okay. The claim on Bank of America is not as solid, it's not as liquid as the actual currency or reserve balances with the Fed. Okay. So again, in our system, legally, a reserve balance with the Fed is interchangeable with the green pieces of paper. Another way of saying it is if Citibank has whatever, $100 million on deposit with the Fed and reserve balances, Citibank could tell them we would like to withdraw that in the form of currency. And then, the Fed with the Treasury would print that up if they had to and hand it over to them. Okay. And then Citibank's or if I said Bank of America, I'm getting mixed up what I said. The reserve balance electronically would go down, and then they would have extra cash to put into their vaults so they could then put out in the ATMs and so forth. Okay. But if you have $1,000 on deposit with Bank of America and you want it, they need to have that physically in their vaults. Bank of America doesn't have a printing press on hand that, if the public wants to withdraw money from its checking account balances with us and we're short, we can just print it up. No, that's why bank runs are possible, right? That's why it's an issue that we have what's called fractional reserve banking, because if the public did try to ever withdraw all of the money that's, quote, in their checking account balances, they would find there's not enough reserves to satisfy everybody all at the same time. And hence, again, that's the problem of a bank run. Okay, so in George's video, he's acting as if I'm crazy for thinking reserves are a thing. And no, doesn't he know all these dollars that foreigners hold are just created and that's not correct, right? There does have to be an underlying reserve asset. And so when it comes to foreigners who are trading dollar claims against each other, back and forth. So to one party, it's an asset, to the other party, it's a liability. What keeps that system up and running, the foundation of it, is occasionally somebody calls the bluff and they say, yes, this institution over here owes me 10,000 US dollars, and I want to get something that is a liquid claim on that. Not just them saying they owe it to me, but I actually want it. Now, it doesn't have to necessarily, in the particulars, be $100 bills that institution has to come up with to hand over physically. It could be, the equivalent of claims on treasuries or something, right? Because the US government, people think, is pretty good for delivering on a promise to pay a specified number of US dollars more than some French bank, let's say. Okay. So again, if you think you have 10,000 US dollars, you're more certain to actually have it if you have a bunch of or if you have treasuries promising that, versus some French or German bank says, yes, you have a checking account and it's denominated in US dollars, right? Because those entities don't have the same means with which to create actual US dollars as the US Treasury does. That's obviously the reason that treasuries are considered safer types of USD denominated assets than a checking account balance in some non-US bank. Okay. So given that you've got the underlying USD denominated reserve asset that in many cases is itself intangible because it's just reserve balances held on deposit with the Fed, and then the commercial banks create new dollar denominated assets on top of that, but those types of dollars are of a different liquidity and economic significance than the underlying asset. I thought that's a very subtle distinction. And in practice, it's hard sometimes, if you're trying to just get through the basics, to get people to see the difference between you thinking Citibank owes you $1,000 and Citibank thinking the Fed owes Citibank $1,000. Those are different things. Okay. And notice in both cases, they can be created out of thin air, right? Citibank can make loans to people, and that hence there's more, quote, dollars in the system. And the Fed can certainly just buy assets and create more dollars. But when the Fed does it, the dollars it is creating are base money, are legal tender US dollars that can, satisfy any debt obligation under US law. Whereas what Citibank can create is not the same thing. Right. And again, that's why bank runs are possible. Okay. So because of that, that's why as a pedagogical tool in my article, I thought to disentangle that, to separate out the reserve type legal tender US dollar from what banks pyramid on top of it. Let's, in my article, talk about something tangible like gold, like bars of gold, and then foreigners issue claims on top of the bars of gold that are fractional or reserved. Okay, so that's what I get into in that article that George is going through and critiquing. All right, another curveball that was thrown to George there was my scenario one. I just said no. There's just physical gold bars, and there's no leverage. There's no issuing of more notes on a given gold bar than just the underlying asset. And again, the reason I did that as a former college professor, as a pedagogical tool, often before you jump right into and explain the full-blown, really complicated thing, especially if you're having a disagreement with somebody that you think is intelligent, you start out earlier. You say, okay, let's do a more simple case. Do we agree on that? Okay, now let's introduce this complication. All right. So what I was doing there was saying, I'm having this disagreement with Brent Johnson and George Gammon. I'm saying if investors around the world want to dump US dollar denominated assets, other things equal, that makes the dollar fall. They're saying, no, it can be the opposite. If investors around the world are trying to dump USD assets, paradoxically, the dollar can strengthen against their currencies. So for me to just try to walk through and unpack, whoa, how are we reaching such opposite conclusions, especially since I think mine's pretty straightforward. That's why I was saying, do we all agree? Let's talk about gold. And maybe this is one way of putting it. By focusing on gold, partly the reason I'm doing that is because from a foreigner's perspective, legal tender US dollars are like gold, right? A French bank cannot create legal tender US dollars just like they can't manufacture bars of gold. So from the foreign institution's perspective, having actual USD, whether that, they're sitting on T-bills, or if they have, some kind of swap arrangement with the Fed, or if they themselves, have basically a reserve account with the Fed, maybe through subsidiaries or whatnot. Okay. So, but if, or they could actually have cash in the vault, right? And, depending on the scenario, the specifics could be different, but saying foreign entities that have US dollar liabilities where there are other foreigners thinking that entity owes them USD, those entities must have some type of asset backing that up, right? Just to keep up the appearances, right? Why would people be walking around in Europe thinking, oh, yes, this institution owes us collectively $10 billion in USD if they thought it has no means with which to satisfy anybody, right? Just like in the United States, Citibank doesn't have enough cash on hand that if everybody went to the ATM and tried to empty out their checking account, Citibank would run out of cash. But on the margin, it has some reserves at any given time so that if you go to your ATM and try to take out some cash, money shoots out, right? In order to keep everybody happy with that system so that balances with Citibank trade at par with the underlying reserve asset, it has to be the case in normal daily operations that people can convert between the two without any hitches, right? So likewise, if some foreign entity is on the hook that owes billions of USD to other foreign individuals or entities, just normal operations day in and day out, it has to be able to satisfy those claims. If someone called its bluff and said, I want actual USD or some asset that's closer to USD than your liability, then they could produce that. Okay. But again, those reserve assets, whether it's treasuries, swap accounts with the Fed, or actual green pieces of paper that are in their vaults, from the foreign institution's perspective, that is like gold because they can't just create that willy-nilly the way the US authorities can. All right. So that's why I was doing that. I was trying to distinguish between them pyramiding claims denominated in US dollars on top of those underlying reserves. And hence I went through the scenario with the gold bars. And then again, I started out with just the gold bars with no leverage involved, just to show what would happen if originally you've got a distribution of gold bars around planet Earth. And then what if some people in South America, Australia, and I forget what Africa. What if they had a change of heart about their preferences for holding gold and wanted to get rid of it? And then I just show, well, obviously the gold bars are going to end up migrating north, and the global price of gold is going to fall, right? And so I was saying, can we all agree with that scenario? And I think George and Brent do agree that, yeah, in that simplistic scenario where it's gold bars are the asset and there's no leverage issued on top of it, a drop in certain regions of the world to hold gold as a reserve asset means the price of gold falls. Okay. And so then I just introduced the next layer of complexity. So, okay, now let's make it closer to the Eurodollar system, which is what we're analyzing here, and say, suppose now the people in South America, in Africa, in Australia don't just hold gold bars as reserve assets, but there's some gold bars there serving as the reserves upon which legal claims entitling the owner to the delivery of a 400-ounce gold bar are issued, and it's like a 3-to-1 excess, right? Where there's only 1/3 of the reserves backing up all these outstanding claims on gold. Okay. And so we have that scenario now. And then I said again, what would happen if all of the people in South America, Africa, and Australia who held those assets, who held these paper notes entitling them upon demand to turn that paper into a 400-ounce gold bar, what if they just decided, you know what, on the margin, I don't like gold anymore. I want to get out of gold and get into something else. And so they sold that off. And again, I showed it's the same basic story, that the claims and the underlying reserve assets would migrate north, to North America, Asia, and Europe. And the global price of gold would have to fall in order to induce those northerners to add to their inventories, right? If they're going to be expected now to hold more gold than they were before, the price on the margin, has to fall to accommodate that. So yes, it's a complication. I said that there are notes now that are leveraged on top of it, but that doesn't change the basic story. If the demand globally to hold gold goes down, other things equal, the price of gold falls. And that's true whether or not you're just picturing gold bars being held one for one, or if you're picturing a more complex scenario where some institutions are issuing legal claims on them saying, we promise the bearer of this note, we will deliver 1 gold bar. And then, those claims are included with it when we say people want to get rid of their gold exposure in the Southern Hemisphere. Okay. So that's what I was doing in that article. So, and I still stand by that. At the end of this video you're watching right now, I'll add a complication where you can say maybe there's like an accordion effect where if demand drops, maybe the amount of leverage unwinds somewhat and that shrinks the supply. But even there, that just mitigates the fall in the gold price. That wouldn't make it flip the other way. All right. So I will deal with that complication at the end of this video. But I think at this point, the best way to grapple with George and show why it's not just that I'm arguing he misunderstood me, but no, there's a fundamental flaw in his analysis is let's go through. He has a scenario or an analysis where he goes through and looks at 3 hypothetical foreigners who are holding either assets or liabilities denominated in USD. And then he, walks through and tries to argue, showing that the special significance of this Eurodollar system where all of the assets and liabilities equal each other because these dollars come into existence via credit and debt issuance, that somehow changes the normal intuition that we would think of with a tangible commodity that, well, yeah, if the demand for wheat drops, the global price of wheat falls, duh. So why isn't it the same for USD? And Brent and George think, because there's something special with this market. Before I forget, let me just mention, there is nothing in their analysis that's actually unique to the dollar that wouldn't also be true of any fiat currency with respect to its own internal citizenry. Okay, so if even by the time I'm done with this, if you think, no, Brent and George remain standing and I'm Murphy's wrong, okay, but their analysis then, you would also think that, like in the United States, for example, if Americans suddenly think inflation is going to be worse next year and they want to, quote, unload their dollars, you'd say, oh, so that's going to mean they want to not hold as many dollars. So that means loans are going to shrink, and therefore the quantity of dollars shrinks. And so therefore the dollar should strengthen. And so you would end up with this paradoxical result that if Americans expected higher inflation and wanted to reduce their holdings of cash, that would make the dollar strengthen and prices would fall. And that, no, that's, I hope that's, and again, it's not about the dollar. It could be in Japan, same thing. If the Japanese people all of a sudden don't trust the Bank of Japan and they think that it's, mismanaging the currency and they want to reduce their holding of yen, that would make the yen strengthen. Okay. And then vice versa too. If you thought the yen was going to be stronger and you wanted to increase your holdings of yen, if you lived in Japan, well, then again, according to the logic that Brett and George lay out, that would increase the amount of loans denominated in yen, increasing the quantity of yen, and therefore making the yen fall. And so paradoxically, people try to hold more yen, it makes the value of the currency fall. Okay. So again, this isn't just about the Eurodollar system. If Brent and George are right, this would be true for any country that has a fiat / fractional reserve banking system created currency within its borders. And so I'm hoping if you realize that, no, that doesn't sound right, that something's got to be wrong with their logic. So here, let's look at George's explanation and I'll pinpoint exactly where he goes wrong. So first, we'll just go ahead and let him set it up and talk about the first potential investor.
This, ladies and gentlemen, is how you do a diagram right here. Josh, what do you think of this?
The professionalism is incredible, George.
It is. Do you know how long it took me to draw those stick figures?
How long?
At least 8 seconds. A lot of time and energy went into this, Josh. All right. In all seriousness here. So we'll start with three guys here that represent we'll say the majority of entities around the world that own dollars and that might have less demand for dollars moving forward. So we've got the balance sheets, assets on the left, liabilities on the right. And this first guy is assets. He's got some rupees or rubles, whatever. We'll call it rupees. He's probably an Indian guy. Has to own a hotel. I don't know why every single hotel in the United States is owned by an Indian dude. But anyway, so this guy, a hotel owner, has rupees on his balance sheet assets. And then he also has dollar liabilities. He's got dollar debt. Okay. So this represents an individual that has dollar debt, but has fewer dollars than they have those dollar-based liabilities. Okay. The other individual, pretty much the same. You've got assets. You've got dollar assets. Well, in this case, we'll assume it's cash. And then you've got dollar debt. Okay. Or the other option is that you could just have dollars and then you have no dollar liabilities whatsoever. So that's represented by the third guy that has no liabilities at all. This is every single entity that would impact this equilibrium or the supply demand, let's say, of dollars outside of the United States would pretty much fall into this category. Obviously, you'd have people that have no dollar assets and no dollar liabilities, but they don't really factor into the equation. Okay, so the first guy, and this is Bob's point, the first guy has these dollars, has no dollar liabilities, and he's like, forget it, I'm done. I hate these dollars. I hate them. I hate the United States. I hate everything about it. I never want to use dollars again for the rest of my life. They kicked me off the SWIFT system or whatever it is. So I'm going to sell all of my dollars for gold because that's the only thing with no counterparty risk. Okay, great. So what happens is the asset goes from dollars to gold, and then these dollars are now, let's just say, Josh, you can see my pointer here, can't you?
Yes.
Okay, cool. So now these dollars are just circulating in the global economy. And to Bob's point, demand went down, and therefore you have the supply relative to the demand increase, and the value of the dollar relative to other currencies goes down.
Okay. So you get the basic structure. And I like this, the simplicity of it. He's saying there's three possibilities when it comes to foreigners that have exposure to US dollar denominated assets. And the first case is somebody who's just a net holder of USD assets. And if that foreigner has a change of heart, maybe he watched the zero hedge debate and was convinced by Jim Rickards and me that, yeah, I don't want to be holding so much exposure to the US dollar going forward. So he's going to sell off those assets. And as George says, okay, so now that extra quantity is floating around the system. And just like if somebody's trying to unload potatoes, you would think that would tend to push down potato prices. George is admitting that, yep, just looking at that one guy in isolation, him trying to unload his net dollar assets would push down the price of the dollar against, whatever that guy's local currency is, if that's what he's selling it for. Right? Good. I agree with George so far. Let's continue and look at the middle person.
But this is looking at the situation in a vacuum. This completely excludes everything else that would be happening at the exact same time. So let's go to another example, and we'll assume that the guy on the right wants to keep his dollars and the guy on the left wants to keep his dollars, but the guy in the middle says, you know what, forget this. I hate these dollars. I never want to see them again. I want to get rid of them ASAP. Okay, well, that's fine. But let's remember that if he's got $500,000, he's also got $500,000 of debt that created the $500,000 to begin with. Right? Remember, and if we go up to these balance sheets, you can see that all of the dollar assets were created by what? A dollar liability. We have $2 liabilities and $2 assets. Okay? So what happens is this guy says, I hate these dollars. I never want to see them again, but geez, I can't default on this loan. Therefore, I'm just going to pay off my loan, and I'm never, ever, ever going to have to deal with the greenback again. Fantastic. So in this case, what happens to the amount of dollars on his balance sheet? Or what happens to the amount of dollar supply in the world? It goes down. So the demand for dollars has controlled the supply of dollars.
Okay. Again, I don't have a big problem with this. George is saying you can imagine there's someone in an intermediate position where they have dollar assets, but they also have dollar liabilities. Okay. This could be like a bank, for example, that maybe, some European bank, and maybe in its, on its balance sheet, its assets, it has treasuries, or, depending on the institution, maybe it's got stable coins denominated in USD or what have you, but it has a means by which it thinks some entity that is capable of delivering legal tender USD if needed, it has claims on that entity. So it's USD assets, but correspondingly, it has then, granted loans to its own customers denominated in USD. Okay. So from the bank's point of view, the customer checking accounts with them are, at liabilities to the bank that the checking account is. Okay. So given that now, you can see maybe they want to just unwind. They say, we don't like the dollar in general. And so you can imagine, instead of them selling off their assets, they could just use them to directly pay down their liabilities and just, have the two cancel out. Okay. Again, you'd have to come up with specifics in each case to explain the particulars, but in general, yeah, you can see why if some entity is walking around with dollar assets and dollar liabilities and they kind of just want out, yep, they would go to sell their dollar assets, but then they could just use the proceeds to knock out the liabilities. Whether they literally sell it to get actual dollars and then pay off the liabilities, or if they kind of just do it all in one fell swoop and transfer ownership of their assets, treasuries, stable coins, swap agreements, physical currency, whatever, and pay off their creditors accordingly. So you can see how that would work. Fine. I got no problem with that. George and I both agree on net. That sort of a person falling out of the Eurodollar system doesn't have a footprint on the strength of the dollar. The two things cancel out. Fine. Now, crucially, let's go to the third example.
Okay. But now let's assume that the guy in the middle and the guy on the right want to keep their dollars, but the guy on the left wants to get rid of his dollars. Okay. And he says, I've got these stupid rupees, or excuse me, I've got this dollar denominated debt. I never want to deal with dollars ever again. I'm going to start pricing all of my widgets or my hotel rooms. I'm going to start pricing them in rupees. But unfortunately, I've got this dollar denominated debt and I can't pay this off. So I don't have to deal with dollars again with these rupees that are on my balance sheet. So what am I going to have to do? I'm going to have to hold my nose. I'm going to have to sell my rupees and I'm going to have to buy dollars in order to pay down this debt. So what happens to the value of the dollar? In this case, it goes up, all else being equal. And then this guy pays off his dollar denominated debt, which brings the amount of dollars in global supply down.
Okay. And so here is where I think George has misstepped. Now, I'm going to say something and it's going to trigger people. And I promise you, I will circle back and explain why George is wrong for thinking the way he did. But let me just first change the scenario a bit just to highlight what the mistake was, in my view. Remember, the scenario we're dealing with here is that you have a bunch of foreigners and they have different combinations of US dollar exposure. Some have net assets, some have assets and liabilities that roughly cancel, and some have just net liabilities. All right. And then the assumption is, with new information that comes in, the investment community comes to reduce the favorability on, in its estimation of holding USD assets. That's why people on net want to reduce their exposure to the USD. So that's why the guy who was net long sold off. Perhaps less plausibly, but not a big deal. I'm not going to dig my heels in. The person who was kind of balanced just kind of unwinds it just to not have the volatility. Okay. But now when we come to somebody who is net short USD, why would we assume that if the scenario under a discussion or analysis is foreigners becoming more skeptical about the benefits of holding USD, why would someone who starts out as short want to cover that? Because that means that person is going long relative to their original position. Okay, let's just analyze it like with shares of stock, just to show why what George did there is exactly backwards. Okay, shares of stock, someone says, oh yeah, there's some company out there and the news breaks that they lost this major lawsuit. And we think that that's going to cause the share price to go down because a lot of investors are going to try to unload that stock. Now, what if someone were to say, that's what a naive analysis would say, but you're wrong. Because what you didn't realize is because of that pending lawsuit, this trial's been dragging on, there were a lot of people out there who had shorted that stock. And so, yeah, if we look at somebody who was long and now with the new information, they think the stock is overpriced, so they try to sell at that price to get out, that's going to have some shares entering the market that's going to tend to push down the price. But there were people who, before the verdict came out, were short the stock. And so now that they have the new information and it's worse than what people thought, they're going to cover that and unwind their short position because they want to get out from that stock too. Why would they do that? Right? No, if you thought a stock was bad and you were short and then news comes out that makes it even worse, you're not going to unwind that. Why would you do that? Okay, so I agree with George in general. If for some reason foreign holders of dollar and of US dollar assets and liabilities have offsetting changes in expectations, and the people who were originally long want to get rid of it, and the people who were originally short want to also unwind that, then the two cancel out. But that's not surprising. That means on net, the foreigners didn't have a change in sentiment. Some of them thought the dollar was going to do better, and some of them thought it was going to do worse. And on net, they kind of cancel each other out. So that's not surprising that George isn't getting a movement in the dollar strength if he's assuming the two things cancel out automatically, right? Just like, again, with shares of stock, if there was some bad news that was released, you would say that would tend to push down the share price. If you thought for some reason everybody's short would all of a sudden try to buy up shares to cover their short position in light of the bad news, then that would cancel it out. But that's because why would anybody do that, right? That's why that's a non sequitur. Okay. Now, I told you, I knew if George or Brent's watching, they would be outraged and say, because Bob, there's a fundamental thing going on here. Don't you get it? Geez, how can you be so thick? We're saying the dollar assets that the foreigners hold are not $100 bills. They were created. They were brought into existence by the act of the counterparty making the loan. And so, George thinks there's like quantum entanglement where his guy on the right, by the very act of him selling off his asset, automatically means the guy on the left also has to cover his short. And that's why George thinks there's something very special about this situation where the two necessarily have to cancel each other out. And I'm saying that is wrong. That's just not true. Okay. And I've been trying to get Brent and George to realize this. And that's partly why I was saying in my article, and I didn't play it in the clip here, but George was sighing when he read that and said I went off the rails or something. But no, that's what I'm saying. What they are confusing or conflating is a situation in which there's concern about the reliability of foreign USD denominated debt. And so that might cause people to demand more liquid forms, right? So if somebody starts to doubt the ability of some foreign institution that's got an outstanding $10 billion of USD denominated liabilities, if someone starts doubting their ability to satisfy that, they might say, you know what, I don't want, to just have a checking account with you where you say you owe me, I have $1 million in my USD denominated account with you. No, I think I want the USD. So I'd like to withdraw it. That can cause a problem, and that could make the dollar strengthen. But that's different. The person, it's not that they don't want USD. They do want USD. They're starting to doubt the ability of that institution to give it to them. And so that's why they're trying to swap out of having USD in the form of a checking account balance with this foreign bank, or more generally, some foreign institution that owes them USD, versus having something that's more reliable like treasuries or, checking account denominated and held in an actual American bank. Okay. So again, to return to George's diagram there, if what's happening is not that the guy on the right is trying to swap out and he wants to get a more liquid, dependable form of USD in exchange for what he started out with, but no, if he just wants to get rid of exposure to USD altogether, him selling off that asset does not automatically unwind the loan transaction or the credit transaction that created it, right? He's selling it to somebody else. So if he sells it to somebody else who's non-US, and we're assuming in this scenario that collectively the foreigners want to reduce their exposure to USD, then the price has to drop, right? That if the guy is in Europe and he has $1 million of some other entity saying, we owe you 1 million USD, and he no longer wants to have that as an asset, he can try to sell it. But if Europeans in general are worried about the USD, the only way he can unload it to another European is if the dollar falls against the euro. And so now it becomes cheaper. And then he can transfer it to somebody else. And they say, oh, okay. Not the previous exchange rate, I didn't want to buy, but now as the dollar falls against the euro, this thing now becomes relatively cheaper to me. And so they can buy it that way. Okay. Or ultimately, if no, foreigner wants to hold that thing, an American can take it over. Right? He can sell it to an American. Right? But again, that's making the dollar fall against that person's currency. Because from the American's point of view, he's now going to, let's say it's $1 million, right? So again, the scenario is some French bank owes this guy $1 million, right? So the guy on the right is the checking account holder. The French bank is the person on the left in George's diagram. And the bank owes $1 million to the guy on the right in the form of that guy thinks he has $1 million checking account balance with the French bank. And so if he wants to, he can sell that, as it were, to an American. And so when the dust settles, what ends up happening is the American sent $1 million USD to buy the appropriate amount of euros to then give to that guy, right? Because he doesn't want to hold you $1 million USD. Or if you want to think about the American sends the guy $1 million USD in actual green pieces of paper, or by writing a check, on Citibank, and then that guy immediately turns around and transforms that USD into euros. Because again, by assumption, he doesn't want to hold USD. He's trying to get rid of it. So either way, however you do the mechanics of it, it's on the margin to transfer that claim to the American. US dollars have been used to buy euros, either by the American directly or, by the French guy. And so that makes the dollar fall against the euro, other things equal. And so in that initial situation, the French bank, they didn't sell off their liability. It just, the asset got transferred to somebody else. Okay. So again, that's what I'm saying, that I think the fundamental problem with Brent and George here and their analysis on this stuff is they're assuming that just because the existence of dollar assets implies a mirror image dollar liability from somebody, that doesn't mean if people try to get rid of their dollar assets, that automatically unwinds everything. It doesn't. Again, I think what they're doing is they're confusing it. Certainly, their fans on Twitter, when they were jumping into the discussions I was having with Brent, the fans jumping in, they were confusing those two things or conflating those two things. And they were saying, no, if there's a liquidity crunch and people, call loans in and whatnot, then that can cause a crunch on the underlying, item, and people got to come up with dollars to be able to pay their liabilities denominated in dollars. And so won't that make the dollar strengthen? Yes, I don't disagree with any of that, but that's a different scenario. Right. And that kind of a scenario, again, people become concerned about the ability of the default risk of the USD denominated debts. And so they demand, no, I want the real thing. To say I want the real thing is not the same as saying I don't want dollars. Okay. So those are two separate items. Now, big picture, what is true, you would expect in a scenario like the one I just walked through, where some guy in France, or, could be Brazil or Colombia, whatever, sells off his asset. It bounces around, but then ultimately finds its way back into the United States. You would expect in the long run, that's not going to persist. That ultimately US citizens who are holding dollar denominated assets that are claims on foreign institutions probably are not, that's not going to persist. And probably over time that will unwind, because the Americans would prefer to hold US dollar liabilities that are issued by US based institutions. And so what would happen in practice is any of the reserve assets that was underlying all of that would migrate from the foreign entities back to the United States. All right. So I do agree in the long run, that's probably what would happen. My point, though, is just in terms of the immediate impact on the currency markets, George and Brent are wrong if they think just because foreigners are trying to sell off their dollar denominated assets, the very act of them getting rid of it automatically unwinds the credit transaction that created it. That's not the case. Okay. What happens is by them trying to sell it, other things equal, that weakens the dollar. And so then to the extent that the new owner wants to just let it unwind and mature and then get the underlying dollars, it makes it easier for the entity that's on the hook to do so. Right? So just to continue working with that example, if the guy on George's, right-hand side of his diagram is some guy in France who is owed $1 million, he says, I don't want the dollar anymore. He sells it ultimately to an American. Through that process, as I've just walked through, the dollar falls against the euro. Now that American probably doesn't want to sit around having a French bank owe him $1 million. He might say, I'd rather have a US bank owe me $1 million. So he decides to withdraw that, to cash that in. Okay. And so the French bank now, is it harder or easier for it to satisfy its obligations? No, it's easier. The dollar has fallen. Okay. So that's what I'm trying to get at here is ultimately the price of the reserve asset falls. And so it's easier for institutions to satisfy their dollar liabilities in a scenario where the demand in general for the asset falls. Okay. So it can unwind without there being a spike in defaults. Okay. And so again, in that scenario, what would happen is the reserves would end up flowing back to the United States. And, that French bank would, its portfolio would shrink over time too. But at no point would there be something that would cause the dollar to strengthen. Okay. Last point I want to make here to give a more of a nod to where Brent and George are coming from is something that I did not specifically address in my first article and that I am going to fill the gaps in with in this second piece. This is the second installment. They are right that to the extent that the total quantity of dollars on planet Earth would shrink if foreigners around the world wanted to reduce their exposure to dollars, that would mitigate, that would cushion the blow. It'd be like a shock absorber. All right. So that if everybody just literally had $100 bills, and that's what foreigners held when we thought of their USD assets, and then they said, you know what, we don't like dollars anymore. And they just, went into their currency markets, traded dollars for their own respective currencies, and those dollars all came home like chickens to roost to the US. That would cause, domestic price inflation in the US. Because when we say foreigners hold X amount of dollars, we don't actually mean green pieces of paper. Again, that number is like 950 billion. The total Eurodollar market is way higher than that for the reasons Brent and George discuss. So it is true that if foreigners around the world wanted to dump all their holdings of US dollars, when the dust settled, the quantity of extra USD reserves that would flow back to the US would be much less than the total amount that the foreigners' assets shrank. Okay, there'd be like a reverse accordion effect, or going the other way. When foreigners around the world want to hold more dollars, yes, it does suck some of the actual reserves out of the US and into the bank vaults and other, reserve backing of those foreign entities, but then they pyramid more dollars on top of that. And so that means foreigners, they can gain $10 trillion of dollar assets without 10 trillion in US currency having to leave the US. That's one way of putting it. So then when the process is in reverse and foreigners want to shrink their holdings of USD, it does mean USD flows back to the US, like actual green pieces of paper and other forms, treasuries and, other forms of actual more liquid forms of USD claims do flow back to the US, but it's not dollar for dollar. There's a multiplication effect when it expands, and there's a division effect when it contracts. So on that narrow point, I agree with Brent and George that the nature of the debt-based Eurodollar system, again, provides like an inbuilt shock absorber. But where I think they're wrong is when they think it can flip. All right. So all that does is it mitigates the movements. So it means if foreign demand to hold dollars drops by a certain amount, the dollar doesn't fall against those foreign currencies as much as you would have expected if there were 100% reserves. All right, that's what it means. It doesn't mean, though, if foreign demand to hold USD assets falls, the dollar strengthens. Okay, and so just this is a point perhaps for purists here, but let me just walk you through very quickly diagrams from my textbook on this stuff, just so you can see what I mean. So here, I've got a diagram showing what happens if there's a fall in the supply of oil globally, right? So economists just draw real simplistic supply and demand curves. If the supply curve shifts left, what happens? The equilibrium price goes up, all right? So there you might think, oh, so since the quantity of oil fell, that means the price rises. So in general, if the quantity of something falls, that means the price goes up. Isn't that what Brent and George are saying? No, it depends why the quantity falls. So here, yes, if the reason the quantity of oil in this case shrinks compared to the original equilibrium point is that the supply shrinks, then yes, that pushes up the price on the margin. But what if instead of that, we have a different scenario? So here's the next diagram. And this one happens to be the Apple market. And I'm saying, what if the demand for apples falls? Like maybe the Surgeon General comes out with a report saying eating too many apples, can cause cancer. Okay, so now if the public's demand to buy apples drops, that shifts the demand curve left. And notice the equilibrium quantity of apples brought to the market also falls, right? So you could say, loosely speaking, there's fewer apples now being bought and sold week after week in the apple market. So you might have thought, oh, there's a smaller quantity of apples, and so therefore the price must be higher, right? Because smaller supply means higher price. No, that's why that's why we do this stuff with the supply and demand curves, is just to keep our thinking straight. Okay, that's kind of what I was saying at the start of this video. I'm not here saying I'm a better money manager than Brent Johnson is. No, of course not. That's not my lane. What I, as a sort of academic economist, am good at is thinking through logically the framework that we're using to analyze hypothetical scenarios. And so I'm saying, if you want to know, what happens to the strength of the dollar if the quantity of dollars on planet Earth shrinks, you need more information. You need to know, why did it shrink? If it's because the Federal Reserve tightened policy and, the Fed, in a sense, sucked base money out of the system, and then the banks had to respond accordingly and call in some of their loans, then yes, that would make the dollar strengthen. The Fed jacks up interest rates. It lets its own balance sheet shrink, sucks reserves out of the system. Other things equal, that makes the dollar strengthen. And yet there's a sense in which the global number of dollars shrinks, and that goes hand in hand with this rising dollar, right? But if the reason the global quantity of dollars shrinks is because foreigners want to unload the dollar, and through the mechanism that Brent and George talk about, in the act of them doing so, that causes some deleveraging, and so the total quantity of dollars shrinks. But if the thing that's driving that movement is a drop in demand, then that means when the dust settles, the dollar is weaker against those other currencies. Okay, so just to be clear, in case you got lost there, the reason I walked through those two examples from my textbook is to show it's not enough just to say the quantity of the item fell, what happened to the price. You need to know, why did the quantity fall? In the oil example, if it's falling because, the OPEC nations decide to stop pumping so much crude, the way economists handle that in their analytical framework is to say the supply curve shifts left. Yep, smaller amount of oil hitting the market week after week, the price of a barrel of oil shoots up. But again, with the Apple example, if the reason the amount of apples being sold week in and week out falls is because the public decides they don't want to buy apples as much, and so the demand curve shifts left, then that means the price falls. Okay, so again, big picture here. If we are supposing that foreigners decide as time progresses that they want to reduce their holdings of US dollar denominated assets, other things equal, that leads the dollar to fall against their respective currencies. The fact that their assets were created through a credit transaction that involved leveraging upon a smaller base of actual legal tender USD, perhaps in some cases an extremely small base. That is a complication that does affect the magnitudes of the story and the numbers, but it doesn't change the direction. Again, at best, it's just a shock absorber. Okay, well, that's a good place to wrap up. If you want to see my analysis of Kamala Harris's price gouging proposals, that's a recent video we did. Click the link here. In the meantime, thanks everybody for your attention, and we'll see you next time.